Hi folks, and welcome back to Meaningful Money. Okay, still here at Lanyon Coit, next to this big granite table, stuck here in the middle of nowhere, kind of between Penzance and St Just, here in West Penrith, West Cornwall. Carrying on our little series about mortgages, just a couple more to do on it, I think. And this time I'm going to talk about protecting a mortgage. Right, we've talked about how the mortgages work, different kinds of interest rate behaviours, offsetting, repayment versus interest only, things like that. Now I'm just going to talk about protecting a mortgage, but as ever, before I get into it, my friends down here they are, down in the bottom right, 7 Investment Management, who continue to sponsor Meaningful Money. I must say thank you to them. I'm deeply grateful because they help me to keep going. Right, if you've got a mortgage, you know what a big deal it is. A mortgage is, taking out a mortgage, buying a house is probably the biggest single transaction that most of us ever do. It's almost certainly the biggest debt many of us will ever have, unless you've got business debts or something like that. But having that amount of debt around your neck is a big deal, not to be taken lightly. And so it really ought to be protected. And by that I mean, if the worst happens to you, you don't want those left behind, family, friends, not friends, family, to have to be saddled with your debt. If you get very, very ill, you don't want to have to worry about paying your debt. What you really want to be worrying about is getting better. If you are unable to work, your mortgage still has to be paid. How is that going to happen? So those are the 3 main risks that you need to think about. Protection, remember, is a foundation. All the rest of your financial planning is built on top of it. You must get the foundation right, so that circumstances, can't derail your financial planning. Things outside your control. So, those 3 main risks: the risk of death, the risk of serious illness like cancer, heart attack, stroke, multiple sclerosis, things like that, and your inability to work. Those are the 3 main risks. So death first. Well, you protect against death by taking out life assurance, right? Look back to episode 15. I'll stick a graphic up here, because that talks about term assurance. There are 2 or 3 different types of that. Either decreasing term assurance, where the amount of cover goes down over time. The idea being is that as you pay your mortgage off and the mortgage balance reduces, so does your life cover reduce, keeps the cost down. Or there's level term assurance, where the amount of life cover you get stays the same for the whole length of the term. Look back at episode 15 and there's more detail about that. Serious illness, sometimes called critical illness. Well, there's a special kind of insurance for that, and it's surprisingly called critical illness cover. Look back to episode 19 for that. Now, critical illness cover is getting increasingly expensive. So it may be prohibitively expensive, depending on the size of your mortgage and the size of your budget, for you to protect the whole mortgage balance against critical illness. But a little top tip here: if you can't afford to cover the whole balance of your mortgage for critical illness, look very seriously about, for example, covering 5 years worth of mortgage payments, so that if you get diagnosed with cancer or something horrible like that, you know that there'll be a lump sum paid out, which you can use then to pay off your mortgage for 5 years, so you can forget about it and concentrate on getting better. It's a useful little tip which I've used many times with clients where the cost of covering the whole thing is too expensive. Consider just a 5 years worth of payments and have that as a lump sum critical illness cover instead. And finally then, your inability to work. What happens then if you put your back out, or are diagnosed with serious depression and you are unable to work for a prolonged period of time? What happens then? Well, then you need something called income protection, traditionally called permanent health insurance, or PHI, slightly misleading name. We call it income protection these days. Look back to episode 20. Of these 3 risks, this is the one which is most likely to occur, just for you to be unable to work for some reason. So this is really important that you take this out. It's a really important part of your foundation. So look back to episode 20 on income protection. Now, I was a mortgage advisor originally when I got into this wonderful industry. And whenever I saw some people coming to take out a mortgage, there were a lot of first-time buyers then. I would refuse to arrange a mortgage for them unless they allowed a budget on top of their mortgage payment of 75 quid a month. So I would insist that unless they could afford £75 a month more than their mortgage payment, I wouldn't arrange the mortgage for them. Now, I lost some business on the back of that, but I used to say that because it's so important to protect you and your loved ones against these horrible circumstances, because you've got this big debt around your neck. So if you're going to do a mortgage properly, you must consider protecting it in these 3 ways, ideally. Budget is obviously a concern, but think twice about getting yourself into a mortgage unless you can protect it as well, and don't mortgage yourself to the hilt if you can help it. Okay, right, that's mortgage protection. I'll get off my soapbox and stop preaching now. Next time I'm going to look at the mortgage process, you know, the process from advice to you actually getting your keys and moving in. So join me for that one next time, and goodbye from Lanyon Coit.